Hello, Mark Child, Chairman and CEO of Condor Gold Plc.
Mark Child, Chairman and CEO of Condor Gold Plc. How are you, sir? It's been a while since we've seen you, and I can see what you've been doing. You just put out a feasibility study for La India project. Do you want to give us the highlights?
Yes, certainly. The feasibility study, or bankable feasibility study, is on the main La India open pit, which has a mineral resource of about 900,000 ounces. And we have a reserve out of that now. And that gives us 82,000 ounces of gold per annum for a 6-year period. And the total upfront capital cost we've kept deliberately low at $106 million US.
Right. So it's a small but perfectly formed project. How do you make this bigger? Do you need to make it bigger?
That's a good point. We've actually got 3 permitted pits. And last year we put out PEAs about 12 months back. And so what we would do is out of the main, the feasibility study is on the main pit. But just to remind readers, this means it's plus or minus 10 to 15% accuracy for CapEx and for OpEx. There's like $8 million has gone into the studies on the hydrology, the metallurgy, the processing plant, the tailings. Many of those attributes of the bankable feasibility study are the same, regardless of where you get the actual ore from. So the processing plant's the same, CapEx and layout, the tailings is the same, the water management and various other parts, or all the metallurgy is all the same. So what would happen here is that, the reason for doing that is it provides enough cash flow out of the main pit to finance any bank debt, and I can talk to that in a moment. But to answer your question, we have 2 high-grade feeder pits within 3 kilometers of the plant, which we would drill out and bring into the mine plan during the construction phase. So day one, gold production won't be 82,000 ounces of gold a year. It'll be over 100, between 100 and 110,000 ounces per annum.
Right, but you're going to need to raise money for this, potentially, and I'll come back to potentially, is the jurisdiction in which you're operating, Nicaragua, investable? The US don't seem to like it very much.
Yes, that's a good question. I think that there will be we've deliberately kept the upfront CapEx low, so $106 million, and this is all brand new equipment on feasibility studies. So we could get it in lower, and it includes 15% contingencies and an $8 million EPCM contract. So regional development banks, because Nicaragua is a poor country, private equity funds, who lend all over Africa, for example, aren't put off by political risk, and gold loans. So I don't think it's typical US banks. Let's just forget that for the moment. But it's these other 3 categories of project financing that we've had conversations with, and I believe will lend to the project.
Right, but ultimately it's dollars. So I guess the US does have a say in this. So are there any kind of restrictions in terms of the groups that you could be talking to in terms of the funding component, or do you genuinely believe this is something that you could get over the line?
I think we can get it over the line. I think the banks in the last cycle stopped lending a lot to the junior projects. I mean, if you're a Societe Generale or you're a big bank, it's the same amount of work whether you lend $60-70 million, say, to us for bank debt on a 60-40 ratio, or whether you lend $200-300 million or $500 million to other bigger projects. So at the smaller end of the debt scale on natural resources, it tends to be private equity, gold loans coming through, or regional development banks, and that's what we see is possible on the project finance.
Right. Okay. So what I'm looking at is a company was telling me they can produce over 100,000 ounces of gold a year, right? Valued at $40 million today. So there's something I'm missing, something the market's missing, something you're not getting credit for. So I want to break down some of those moving parts. You talk about a life of mine all-in sustaining cost of just over $1,000. So you're going to make money even at today's depressed prices. You're going to make money. So the being able to raise the capital is one solution, or do you make that someone else's problem? Do you sell the company? Do you sell the asset? I mean, what are the options actually available to you?
Well, there are a variety of options. We are a listed company, and one of the ways we think about creating shareholder value is to de-risk the project. So typically what happens in natural resources, you do a PEA, a pre-feasibility study, a feasibility study, and then you say, oh, it's economic and we've got no fatal flaws of water or metallurgy or construction, and here are the numbers. And then you go and get permits. And we've done this to create shareholder value, we've done this the other way around, where we've already fully permitted to construct and operate. And we've also bought all the land for $4.5 million. We bought a SAG mill for about $7 million. And we've bought the surface rights, which are important in this part of the world. In fact, yesterday, we got the title is being cleaned on the land that we bought, the 55 plots of land we bought. So it's just de-risk, 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 de-risk. And that's needed whether you build this yourself or somebody else pops over and says, I can see a mine here, that it's my next mine. So we are open to the strategic returns as to what's best for the shareholders.
Okay, I get that, and that's a very politic answer. You've got all options available, whatever's best for the shareholder. I get it, but the reality is, like I say, I'm pointing to your ability to go and raise capital. You're telling me you should be able to get that over the line with different routes available to you, or you could bring in a strategic partner and use their balance sheet, or you could flip this thing out. But they're also going to be looking. They're also going to be looking at, will there be any sanctions imposed on Nicaragua? Ortega got back in for a fourth term recently. You actually met some of the. I think you met one of the ministers. Have you met Ortega? Is that
Yes. I had a 90-minute meeting with him back in March this year, and I met the Minister of Energy and Mines 3 weeks ago. Again, I met him a dozen times. So They're very pro-mining and very, very open for it, to foreign direct investment coming in. And unlike, say, Argentina, you have a fully convertible currency, which is important, obviously, for any mining company wanting to repatriate earnings. So I think there will be some people who will look at Nicaragua and do their political risk assessment and say that it's not for them. I would say that. And I think that's up to listed companies around the world. And some have want to just take an example. Some of them only operate in Australia, only operate in North America, and don't even look at Mexico, for example, which has lots of challenges. Or they don't operate in Peru or Chile, where they keep changing the mining laws. So, and yet there are other juniors or other bigger companies that are almost agnostic of political risk. In other words, they say, where's the best gold deposits? Can I have a quick payback? Can I put this up for low capex? Can I permit? Can I operate at a mining level? And I'll worry about the politics later. And you've had big projects. I mean, take Barrick, biggest gold mine in the world is in the DRC. Namibia, South Africa, there are lots of countries that mining companies go into where the political risks, the Congo, where it's challenging, let's say, politically.
But do you think that's still a thing? With last year, sort of the rise of the ESG rebadging of everything and anything. Understanding about the need for social license and so forth, and environmental license have become much harder to get a hold of, or EIA, DIA, wherever you are in the world. Do you think companies at the end of the day, investors at the end of the day, will look at the bottom line, mining at all costs, or do you think that kind of resurgence of this kind of, whether it be green metals or however you want to frame it, is genuinely important, will matter to investors and companies alike, or there will always be a buyer who's looking straight at the bottom line?
I think it matters. In my case, it matters to me enormously that we actually get the social license to operate. I think that's the key thing. It's the people and the communities that you're operating within. And I would put communities and people and job creation and food on the table in the poorest company per capita GDP in South America first and foremost. And then if you like, and so I put social first and stakeholder engagement and social. And I would say projects like us get permitted from the bottom up, i.e. the communities want it. And the governments typically, before they even give you a permit, they will send people into the community and say, how's this company doing? How's it treating you? And what we've done is spent huge efforts on putting water purification projects in for $250,000. We've done training courses. We're training 120 people now for the future workforce for the mine. And we've been running these half a dozen different engagement policies over a 6-year period. So this is maybe even longer, 8 years. And so that's been absolutely critical. And part of the reason for that is that in Nicaragua, under the mining law, you do all your technical studies, the 16 to get your permits. You give them to 4 different ministries, and then the technicians at the ministry says, yes, your tailings storage facility is good. We've got the plans when we approve them. But now you have to go to a public hearing and a public consultation. So the community has to vote whether they want the project after you've done all your drilling and all your technical studies. So it's quite egalitarian in Nicaragua. And I think it's a really good way to do it, because what it forces you to do as a CEO is you can't just say, right, I'm going to just focus on the technical studies and the mass and the bottom line and everything else, because that's worthless if you haven't got a permit. And to get the permit, you need to have the communities and social side absolutely spot on, a bit like the British Army do with the Gurkhas in Nepal. We have 50,000 soldiers, potential soldiers, coming in because there's a massive social license to operate for sort of 500 jobs. And I bring that in because in my youth, I was a Gurkha officer. And so those skill sets that I learned for 6 months in the Himalayas and Nepal, paying out pensions and water projects, I've taken into Nicaragua. And that's one of the reasons we're fully permitted. So I think that, but back to your point, I think that side's absolutely critical. And I think mining companies have understood this for years. I think the ESG bit seems to be partly people sitting at their desks in London or New York or Canada creating jobs for themselves. The good mining companies actually get on with it. We got to do that for the communities, and regardless of whether we're listed, unlisted, you still got to put a huge amount of effort into the social license to operate.
Let me come back to this point, because so it's going to be sort of a conversation flipped on its head. I suspect you're going to be defending the situation, and I'm going to be pushing you, which is that if I'm a mining company with a big balance sheet who operates wherever in the world, and I'm looking at you, you've got your permits in place. If I come in and either partner with you or buy you, I don't have to wait around at the end of this for another 5 years waiting for the relevant permits and licenses to do this. I can get going straight away and start. You're saying potentially with the satellite pits, over 100,000 ounces a year. We know the margins are good, and I know inflation is there, and getting equipment on time is there, and that adds to the costs, and getting people, and it's an inflationary environment. You're getting pressures from bottom up, but you're also getting pressures from gold price coming down, but you're still operating with a decent margin there. And it's a recent feasibility study. It's very, very attractive to people looking in. Is there an element of you that says, look, if that's the route we choose to go, clearly you probably want to get this in production yourself, but if it's the route you go, do you have to be selective with who you would sell it to in that way? Because there will be groups who say, well, we've got to mind our P's and Q's, but there'll be other groups saying, man, the bottom line is pretty darn attractive here, because the money's going to be cheap for us because we've got a decent balance sheet. We can get into production real quick and throw off a lot of cash, which may help us elsewhere. So I mean, objectively, if on that side of the equation, do you have to be selective with who you sell us to, or is it again just a numbers game?
There's a hypothetical questions if we sell it, I think we need to run two tracks. We need to run the businesses we're doing to take it into production, be seen to be doing that by the government and the communities, which is important, but be open for inbound inquiries coming into it. There's two or JVs or whatever happens. So yes, if somebody writes out an enormous check for the shareholders, just like any listed company, they're in property or mining, the board of directors will have to take a look at it. If it's cash, I think you're fairly agnostic. It's cash. If it's shares, you have to do your reverse due diligence on who it is. So if it's a company the same size, or a small company that's illiquid, or it's operating in the Congo, we have to think really hard do we want their paper? If they can come up with a nice price, but it's all paper and something we don't actually like, then you're not going to take that. And so I think there's an aspect of that. If it's a massive company where paper is almost as good as cash, then that's could be much more palatable. But you're right. There's an 18-month construction period, and the Australians say they could build this in 12 months. And in terms of the inflationary pressures, our feasibility study is done at 1,600 gold as a long-term gold price. And that I think is quite conservative. I know gold's only slightly above that at the moment. But to give you an idea, at 1,600, and on our capex number, I mentioned 106, is at the 31st of July. So we repriced everything at the inflation high. And since then, oil's off 30%, and steel prices and other prices are off. But in our document, when it goes out and filed on CDAR, it'll be 31st of July. So they're for capex and opex numbers. So they're right up to date. If anything, they might be a bit high over the longer term. So I think we deliberately kept the capex down, understanding that it's Nicaragua, and as you indicate, it won't be the easiest place to raise cash for, but we haven't come up with a $300 or $500 million capex number. We've come up with 100. And I think that's really, really doable for the country.
Okay, so let's look at the other side of that. So I want to kind of push you on that route. But with regards to, if you decide to finance this thing, however that is structured, is you've got to look at the market at the moment and go, man, it's risk off. People are cash in hand, waiting to see what on earth happens, how this plays out. I mentioned gold price down at the moment, costs up at the moment, although slightly improving, less price gouging going on. You've got to time this right, because if you rush into it, one, it could be expensive money, and two, it could be into maybe there's a re-environment ahead of us. We just don't know. How do you play this? Take your time, sit back and watch, get on with it. What do you do?
I think we have to make some progress on the ground. There's other work we can continue to do. So we're doing a gap analysis. Actually, at the moment, we have Kate Harcourt, our Chartered Environmentalist Director, flying out in a couple of weeks for gap analysis for the Equator Principles, on an ESG gap analysis, I should say. So we're still sort of focusing on that. I think with the risk, with your comment about cycles, Matthew, I would just say that gold price, yes, down 400 off its high, inflation up. All these are traders and investors' views. From the trade perspective, when they enter a new country like Nicaragua, that's not a 6-month view. It's a 10 to 20-year view. And when I'm speaking to mining executives and they're looking to put a mine up, they want to be there for 20 years. And so it's very different. And they are totally the sort of people who can take slightly contrarian views, if you like, compared to the stock market, and say, actually, this is really good value. I can see there's 46% gross margins on this. So in our FS, in our statement, one of the things, just on the single pit, we said that the EBITDA was 40, the gross margin was 46, and then after sustaining capital and royalties, it threw out $355 million at 1,600 gold. And we're looking to borrow maybe 60, 70. So the debt coverage is 5 to 6 times just on that margin after sustaining cash and royalty. And if you go up to 2,000 gold, just as an analogy, which is anyway gold was earlier this year, you add another $200 million on of EBITDA. So the EBITDA goes up to 550 million. So it's very quick paybacks on cash. And I think people who know what they're doing, the mine builders of this world, will look at that and say, that's a tier 1 project. I mean, and I throw it back to you, how many projects do you know out there that have 2.4 million ounces, are fully permitted, can do the 100,000? At the underground we get to 150,000. Have feasibility studies, have the land, have a mill in the country, a new SAG mill in the country, have cleared 14 hectares of site, own 100%, there's no 30% to somebody else, and the government saying, get on with it, build the mine.
Very few. I'm going to answer your question. Very few. And I tell you what, they're valued at 10 times what you are.
And if this was in Nevada, or Canada, it would be worth 5 to 10 times more. The fact, so you could argue that the part of the valuation challenge is Nicaragua. For reasons you've already mentioned.
But right, okay. But there's two things here. So if we look at those two routes, okay, you get this thing funded, and you start throwing off cash, the payback is super, super quick, right? And some people may have a problem with you doing business in Nicaragua, and that's fine. That's their choice, and they can make decisions off the back of that. Others won't, and that's their choice. But if you can raise the money and the payback's that quick, your 40 million valuation today, your share price 25.3 p, looks super, super cheap. I mean, ridiculously cheap, but you've got to get into production. You've got to make money. You've got to sell your product. You've got to, make your margins. And the same for, and the same is for if you decide to sell this, make this someone else's problem. Your challenge there is, how do I get more than the current enterprise value of this company is currently portraying for this project? You can't have conversations about selling this at these prices. It would be, yes, it would be contrarian on the part of the buyer because it's like ludicrously cheap in the context of the numbers you're presenting.
Yeah.
How do you move it? How do you move that dial?
I think well, it is ludicrously cheap. I agree. And if we just talked in dollar terms, and that's a dichotomy. We have say dollar terms, $50 million US market cap, or sort of under that with the cable where it is now.
It's one and one these days, Mark.
Well, thank you. Well, in that sense, it's even cheaper now. We've got a US dollar based asset, so actually the share price should be going up just on the currency adjustment for where we are. So actually, it makes it even cheaper to buy a sterling penny stock for the Americans. Or all Canadians, or anyone. I think that we should be focusing on the NPV of the project. So any conversations that we have, we won't say, look at our share price, let's have a conversation about a share price premium, let's say, or an asset price. I think the value of the asset, maybe this walks down an asset sale. You say, actually, our NPV for the 3 open pits in the PEA was 320 million. If we add the underground in, it's 450 million NPV or 430 million NPV. So how do we close that gap between $50 million valuation on the stock market and a $430 million NPV? So back to your point, there's multiples that we can show. So I think how do we close the gap? We'd have to have a negotiation on the basis of production ounces over the life of mine. That could be 1.5 million in the ounces of gold produced out of this in the PEA scenario. Well, even at $1,600 gold, you can see that's $3.5 billion. Okay, it's going to be 9 years coming out, but so you need to. I think the conversation needs to surround the asset value of the company and try and have the conversation going that route.
Okay, interesting times. And competitive tension always helps in that. Well, look, sorry to kind of take you way down that track. I'm sure that you've got other things that you want to talk about, but I'm so intrigued by the way that management, boards, CEOs actually think in an economic environment like this. We're talking a lot about contrarian investing in most conversations because I think it feels like there's a lot of deals on the table at the moment which are at 40-50% discounts to their year highs. Projects haven't changed much. They just got a bit cheaper, and personally, I'd be running to that side of the aisle if I saw that. So interesting. With regards to other things that I kind of read about since we've last spoken, you kind of worked on the metallurgical study side of things. So nice recoveries. Happy with that, as expected.
Yes, well, we had a slight delay in the delivery of the feasibility study, and one of the reasons for that is that we had to redo a lot of metallurgical test work, and the original bulk samples we didn't have enough of the lower grade in, i.e. 1 gram materials. Our average grade is 3, so they focused around that. And what we had was the lower grade, because there wasn't enough sampling, they said, it's 85% net recovery, and they just applied a standard cutoff. We redid all the met, and guess what? It's not 85%, it's 93% met recovery in the lab. So we got higher numbers, but it's very easy metallurgy. It's 93, grinding down to 75 microns, it's 93% net recovery. In our economic models, we'll use 91% just to be conservative. If we grind a bit finer, you can get an extra 2%. It could be 95% in the lab. So they're fantastic met recovery. There's no carbon which locks up when there's a project in Nicaragua where there's carbon in and they've got problems. 76% metallurgical recovery. There's no sulfur. It's a very, very low sulfidation system. So, people look at the Met you spend $750,000 on because that's critical to understand. You design your plant around it, and it can be a fatal flaw in a project. And delighted to say that Niger project we've got. As someone said to me a few weeks ago, "How come you're so lucky with your metallurgy?" So we can be reassured of that.
Well, Mike, what I guess for me, it's like, okay, great news. Thanks for coming and talking about the feasibility study. I know it's a little bit dated now in the sense that it's a couple of weeks later, but no, it's only a week later, isn't it? Or so? No.
It's 2 weeks ago yesterday.
It is 2 weeks ago, yeah.
But it's still got to be filed. So you get a press announcement.
Okay.
Because we're joint listed on Canada and London. So we do everything Canadian 43101. So we put a press announcement out saying, here's the summary of all the studies, the dozen studies. And then the 43101 report gets filed 45 days later. So that'll be filed in another 30 days.
Okay, I wasn't too far wrong then.
We're in the middle.
We're in the middle. With regards to the money side of things, because okay, you've done this, and then guess what? The so what question comes in, which is right. So what do you do now? What do we see next? And clearly, raise some money back in June, just kind of obviously get the feasibility study over the line. And so depending on your strategy, you're either going to need to raise a big chunk of change or a little chunk of change, but money nevertheless. So what are the plans?
Well, on the debt side, as soon as you get a bankable feasibility study out, an awful lot of people want to talk to you because they smell the fees. So no surprising that at the Precious Metal Summit, I was. So gamekeeper turned poacher, or the other way around. I'm not sure which way I am on that. But we ended up that we've had in the last 2 weeks half a dozen conversations with lenders in Canada and North America at the two conferences that I've been to. So I think to turn around and say we've lined up the project financing, the debt package, or mezzanine debt or gold loan package to say that someone's kicked the tires, they reviewed everything, and here's the debt component subject to XYZ. I think that would be a major comfort for investors because it would be a third party doing due diligence to say, yes, we're prepared to lend and the project can support this much debt and finance. So we're working on that. On the equity side, we're running a business with negative cash flow, but we've got the bulk of all our studies out the way now. That was what we raised the last money for, and we said at the time that's to complete the FS. And we had a small top up to complete the FS. We've done that. We have a much lower burn rate at the moment, but at some stage going forward, we're not producing gold yet. There will be some equity raise. I can't really expand more than that.
Okay. Well, I'm sure you'll tell us when you can tell us, because you need to make a decision about how this project advances, because everything's there. It's wrapped up in a nice little parcel with a bow on it. Either you move it forward or someone else does. So yeah, stay in touch. Let us know how you get on, and we'll be delighted to take that phone call.
Great, and thanks very much for the questions.